early in the year, both metals surged. Okay, January, February, March, April. Okay, and in fact, silver I think made a secondary high at $35 in March, if you recall. And since then, if you look at gold, like from April close to the present, May, June, July, now in August. Okay, total sideways. You almost go back in history and never find an instance where gold goes to sleep, especially after a big advance. Well, what we tell people is, hey, gold doesn't top this way. Never. Okay. When it tops, it tops. You make a high, you drop sharply, and then you work your way on down. But during that time when gold was asleep, silver went up. Silver miners went up sharply. In fact, since April, you go back and look, it's just an amazing wake up for what had been the sleepy end of the monetary metals sector, gold, silver miners. So they're back into a technical leadership position versus gold. And ever since April, you can see it. Gold sideways, they go vertical. Okay. And I think that's going to continue, that outperformance by the silver and the gold and silver miners. So gold is still in the stall mode. I suspect it's going to come out of it very shortly. Maybe they're waiting on the talks today, the big Trump talks with the Europeans and all that stuff, which really doesn't matter in the long term anyway. But our expectation remains that silver is highly likely before the end of this year, which is to say a handful of months, take out its all-time nominal highs, $50, and end up in the 60, 70 range before it even pauses. Okay, not that that's the top, but just the. And if you think about it, like, you use the word nominal, I think. If you think about it in real dollar terms, I mean, good grief, if you factored in the growth in the money supply, degradation of the money unit, since 1980, when silver was at 50, or since 2011, when silver was at 50, very briefly both times, by the way, silver would probably have to be $200 right now just to be in equal to those highs, okay? And don't be surprised if that's what ends up happening. But right now, our expectation is from a trading perspective. Not, long term, we're going a lot higher. But between now and the end of the year, I think there will be a burst that's already begun, actually. If you look at late June, we were coming up through 33, 34. Now suddenly we got near 40 recently. No, excuse me, the upper 39s. I think getting up into that zone will be like a refreshing burst up out of the mire, of silver's vast underpricing for the last decades. I think this time around, it's different. I don't think we have a normal bull market in monetary metals here where you're going to go up to gold, $850 and then drop back to 200 like it did between 1980 and 2000. Go up to the $1,920 high in 2011 and drop down to $1,050, that kind of stuff. I think there's enough major macro, technical, and fundamental events underway globally, but also focused in the U.S. because we're the greatest error out there right now in terms of the bubble, stock market bubble particularly. That when that breaks, and it will, and I think we're in the process of topping the S&P and the NASDAQ and breaking that bubble, that the consequence monetarily will be a global shift here, there, more, there, countries adopting money that's backed by gold as opposed to fiat. I think that thought is already out there. The Chinese are already expressing it to other countries as well. And silver is, after all, I know everybody likes to think it's an industrial metal, but if you go back and look at its history, its major swings up and down, forget about this week or that week, okay? It moves with gold. It doesn't move with industrial metals, okay? Sometimes the industrial metals like copper and so forth are in sync with silver, but don't let that confuse you. It really does not follow the commodity complex so much as it is in step with gold. So even silver could be monetized, okay? Not only they're not going to tax gold and silver transactions, it's just like money, buying something. They are legal tender. Whoa, what a statement. I mean, when a state government describes gold and defines gold and silver in their state as legal tender. In fact, I think in some of them you can pay your taxes. In Florida, I think, set up agencies to service tax payments through gold. They're in effect miniature rebellion against the national monopoly, Federal Reserve, etc., over what is money. They're saying, no, we decided this is money. Okay, that's a rebellion. And I think as the events of the unwinding of the asset bubbles that have been boomed by monetary expansion, by free money for 10 of the last 15 years, et cetera, that when that breaks, all the errors associated with that bubble that are exposed during the breakage process, that's when people rethink what is reality, what works. That really hasn't worked. Let's get rid of it. It becomes emotional at some point. And I think we're on the cusp of that. That's what I think will help drive the acceleration phase in the monetary metals. It's already underway. They're anticipating reality. They don't wait for it. Gold rarely waits for the stuff that you look back and say, oh, now I understand why it went up. It knew it ahead of time. Okay, somebody did. And I think we're at that phase now where once that other stuff crumbles and that asset flows start to seek homes elsewhere, well, there's usually very few homes for it. Safe places, gold and related, and T-bonds. T-bonds aren't working this time. So it leaves you one thing, monetary metals.
When you really sit back and think about it, the year 2025 is behaving almost exactly the way textbooks tell you it shouldn't. Gold, after surging early in the year, decided to take a nap. January, February, March, it was roaring. Silver even pushed up to that secondary high around $35 in March. Then what happened? Gold went to sleep. Total sideways from April through August. And I can tell you something. Gold never tops this way. Never. A real top is like a mountain peak. You make the high, you fall off a cliff, you tumble, and you keep tumbling until the market is crying uncle. What we've had here isn't that. This is not a top, it's a stall. It's the classic consolidation before the next leg higher. Now, while gold was snoozing, something else woke up, the rest of the sector. Silver, gold miners, silver miners. April onward, they've gone vertical. And I don't mean a little uptick. I mean leadership. You can plot it on a chart and see it clear as day. Gold flat, silver and miners charging ahead. That's the market telling you who's in control now. And this is exactly how every big move evolves. First gold leads, then the miners, then silver. And when silver grabs the baton, it doesn't jog, it sprints. Let me paint a picture. Silver hasn't seen its all-time high of $50 since 1980 and 2011. Both times it touched that level briefly, violently, like a firework exploding in the night sky, then falling back to earth. But here's the kicker. If you account for money supply growth and the degradation of the dollar since those years, silver today would have to be $200 just to equal those highs in real terms. So if you see it sprinting to $60, $70 by year end, as I think we will, don't be surprised. That's not a blow-off top. That's a stretch and a yawn before the real sprint. And why do I think silver will do it this year? Because the technicals say so. Momentum analysis, not just price. People love to look at price charts and argue about resistance levels, Fibonacci retracements, Elliott waves. I like to go deeper, to momentum. That's where the truth lies. And momentum is screaming that silver broke out in late June when it cleared the $33 to $34 zone. Since then, it's been teasing $40. They keep trying to sell it at $39.90 because $40 is a big round number, but you can't suppress demand with psychological tricks forever. This thing is primed for liftoff. Meanwhile, gold is just marking time, waiting, stalling. But don't let the boredom fool you. Gold rarely waits for the newspaper to explain why it's rallying. It moves ahead of events, then later the journalists retroactively say, oh, that must be why. Somebody knew, somebody always knows. And that's what's happening now. Gold is coiled. Once it clears $3,500, the next plateau is likely $4,000 or higher. Now let's zoom out. The macro backdrop is the most combustible I've ever seen. We're living through the greatest stock market bubble in history, led by the NASDAQ 100. Think about it. Since 2009, the NASDAQ 100 has risen 19-fold. 19. The S&P 500 is up 10-fold. Never in the last century has any major index done that over 15 years. And it wasn't magic, it was monetary heroin. 10 of those 15 years were zero interest rate free money years. The Fed pumped M2 to the moon. They stopped briefly, pretended they were responsible, then started pumping again. What happens when you pump cheap money into a system for a decade and a half? You inflate bubbles. Stocks, real estate, bonds, venture capital, crypto, you name it. It's the everything bubble. Except, as I like to say, it's the almost everything bubble. Because two things have not been in bubbles: gold and silver. They're the anti-bubble assets. And when the everything bubble bursts, guess where capital flees? That's right, into the only things left standing. We've seen this before. In 2000, the Fed paused hikes, then cut rates, and the stock market topped and collapsed. In 2007, the same. They paused, then cut, and within weeks the top was in, followed by hell on earth in the markets. Rate cuts don't save bubbles, they pop them. We just put out a report called Tombstone, because if you look at the charts, the moment the Fed cuts is the tombstone over the stock market's grave. And right now everyone's salivating about cuts. JP Morgan says 4 cuts this year. Analysts predict a half point in September. That's like giving morphine to a cancer patient and pretending it's a cure. It feels good for a week, but the disease kills you anyway.
The point being, could they actually go absolute ape and take us to a Venezuelan situation where everything goes up and it's absolutely meaningless, except gold, of course, would go up and hold its value, whereas the others would not quite keep. I don't think we're going to reach that point. I think, yes, we have a semi-Venezuelan situation globally anyway, where governments constantly print money, destroy the value of money decade by decade. Not quite the level of the Venezuelan situation or the Weimar Republic, So I don't think that's going to happen. We'll still have the boom bust, and the bust is happening. In fact, right now, even this teasing new high we made in the stock market, NASDAQ 100, S&P, where we went up, exploded off that April low, which, by the way, when it made that low, that was our bounce point. We predefined that the S&P would likely bounce from 4,800 and the NASDAQ 100 from 16,500. That's almost precisely where that low was. They turned up. We didn't argue they were going to make a new high, except they're going to have a good bounce. Instead, they went up and made the new high. Again, a marginal new high. But the speed of that recovery was very rapid until they got to the new high level, challenged the old high, which was late 2024, early 2025 levels. And then when they broke through it, they didn't explode. They crawled. If you look at the week-to-week action in the indexes since that April low, there was a dramatic bounce. Once they got and, quote, broke out over the old high, it was creepy crawly. It's really bizarre. It's like, what's going on here? Well, there's a lot of buying, but it's just not having the impact. Title was Technical Analysis of Stock Trends. Okay. It's a 400-page monster book with fine print. And it deals with chart patterns that they discovered, developed, and defined throughout the book. And one of the patterns, which is long forgotten by most technicians, price technicians, it's called the broadening top. The broadening top is a very deceptive topping pattern that teases you into being comfortable. What it is you make a high, then you have a sharp drop. You turn around, make a higher high, point number 2, then have another drop that actually takes out that prior drop. So a lower low, you get a higher high, lower low, you get a widening pattern. And then it's the third upturn that makes yet again a third new high. It's that one you got to watch, because if it's a broadening top pattern, which I argue we are highly likely in, because momentum argues this new high is no good. It's when you turn down from that third new high in this widening pattern, not a narrowing triangle like everybody likes to plot, but one that's absolutely the opposite. If when you turn down from that new high, like we're doing, let's say right now, if you turn down from here and you get back below the highs we saw early this year in the S&P, which is only like 350 or so points below where we're trading right now, so 5% or so, 5 or 6%. Something's wrong. In other words, that new high was yet another teaser, in which case this broadening top pattern that they defined is starting to unfold. And usually they're disastrous. Momentum of the market, long-term momentum, already argues that you're in a topping process. Because while price has just nudged a new high, momentum's laughing at it. Momentum is, what? New high? The momentum's already broken, in other words. So I'm highly doubtful that this will sustain upside price. And when it rolls over, you're going to get the down. Now, the issue of crash, you mentioned that. I'm not going to argue that there's ever going to be a crash. You could still have a savage bear market, a wipeout bear market without a crash.
Now let's move from the stall to the sprint. The sideways action we saw in gold through the spring and summer of 2025 is the calm before the storm. Every time in history that gold has gone quiet like this after a major advance, the next move was violent. Think 1979. Think 2010. The same fingerprints are here. Silver is already giving you the signal. I've said many times, silver doesn't top with repeated highs. It's not a market that flatlines at resistance. It blasts through. So when you see it sold at $39.80, $39.90, 3 times in a row, you know what that is? That's fear. The shorts are terrified of $40 because $40 is not just a round number. It's a psychological breakwater. Once it cracks, the water floods in, and you can't stop it. And when it breaks, it won't stop at $41 or $42. It'll run to $50, pause briefly, then surge into the $60 to $70 range. And I'm not talking about 5 years from now. I'm talking about before this year is out. And for those who scoff, let me remind you, silver ran from $18 in 2010 to $50 in 2011. That's a tripling in less than a year. So don't tell me $35 to $70 is impossible. It's happened before, and it will happen again. The fundamentals today are even tighter. Industrial demand, deficits 5 years running, solar panel demand, electric vehicles, and yes, monetary demand. Because here's the real story. Silver is a monetary metal, not just an industrial commodity. People get confused because they see it used in solar panels or electronics, and they say it's an industrial metal. But pull back. Look at its major historical swings. They track gold, not copper. Copper can be booming while silver is flat, or copper can be collapsing while silver is rising. Silver's heart beats with gold because ultimately silver is money. Always has been, always will be. That's why it was in the US Constitution. That's why it was legal tender for most of human history. That's why states are now bringing it back. Now, why is this acceleration phase different? Because for the first time, bonds are not working as an alternative. In 2000, when the stock market collapsed, capital had 2 safe havens, gold and treasuries. In 2008, the same. Gold surged, treasuries surged, yields collapsed. That was the playbook. But look at the 30-year bond today. It's stuck in the sewer. Prices collapsed in 2021 to 2022. Yields soared, and since then, nothing. No recovery. You can't hide there. And the world knows it. Jamie Dimon said flatly, "This is not going to pass us by." The sovereign debt market is the epicenter of the next crisis. So you have only one safe haven left: gold and silver. Now let's talk politics again, because the markets don't float above reality. Trump's tariffs are tariffs on steroids. Smoot-Hawley 2.0. In the 1930s, tariffs and a debt bubble combined to blow up the global system. Sound familiar? Today we have an even bigger debt bubble, and tariffs are back in force. The global trade system is fragmenting, supply chains are being rewired, and geopolitics is dividing the world. Over 70% of the global population is aligning with BRICS, China, Russia, the global south. They're setting up alternative trade settlement systems, bypassing SWIFT, bypassing the dollar, settling in local currencies backed by gold. China and Russia aren't doing this for fun. They're doing it because they know fiat currencies are dying. And they're right. You can call gold a pet rock if you want, but central banks are buying it hand over fist. China, Russia, Poland, Hungary, Turkey, even little Czech Republic. If gold is a pet rock, why are central banks hoarding it at the fastest pace in 50 years? Answer: because they see what's coming. Let me bring in a tweet I saw the other day. At Sound Money 1776 wrote, "Funny how gold went from barbarous relic to tier 1 asset in Basel III overnight. Who changed their mind? Not us stackers. The central banks exactly. Basel III elevated gold to the top of the balance sheet hierarchy. Not dollars, not treasuries. Gold." The writing's on the wall. Now let's connect it to momentum, because that's my specialty. Gold has been stalling, moving sideways, but the momentum trend that broke in early 2025 still hasn't healed. Prices nudging new highs, but momentum is hugging the underside of the broken uptrend. That's not bullish. That's a warning. It's the market saying, do not trust price. And when do people finally learn not to trust price? When it betrays them. That's the tombstone moment. They get their Fed cut, they cheer, they party, and then, boom, the trap door opens. That's when doubt floods in, panic sets in, and capital runs. Where does it run? Not into bonds. Bonds are broken. Not into stocks. They're collapsing. Not into real estate. Mortgage rates are still 6 to 7%. It runs into gold, silver, and miners. And it runs fast. You don't get time to sip your coffee and think about it. It's a stampede. This is why I say position before the flood. Because once the stampede starts, you won't get a second chance. Let's dig into silver a bit more, because this is where the real fireworks are. Silver has been in a one-year sideways range since mid-2024. Up to $35, back down, up again, down again. A digestion range. In June, it broke out. That was the signal. Now it's bumping against $39 to $40. Once that breaks, you're looking at $50 in a matter of weeks, then $60 to $70. And longer term, $200 is not crazy. People laugh at that number, but if you adjust for inflation in money supply, it's just catching up to its past highs. And the miners, watch them. They're already outperforming gold. That's not random. That's smart money moving early. They know what's coming. Historically, miners move 2 to 3 times the percentage of gold. If gold goes 20%, miners go 40 to 60%. If silver goes 100%, miners can triple. That's leverage. That's why institutions are finally nibbling again. Now, some people ask, Michael, what about a crash first? Couldn't gold drop to $2,800 in a panic? Yes, it could. We saw that in 2020. Gold crashed 25% in weeks, from $1,800 to $1,450, but zoom out. On a 5-year chart, it doesn't even register. It was a blip. This time, if we drop $700 from $3,500 down to $2,800, it will feel scary, but it will be brief. And then it will slingshot higher because the Fed will be forced to print again. The repo plumbing will clog, hedge funds will scramble, the Fed will panic, and the response will be liquidity. That's always the response. And gold loves liquidity. So yes, brace for turbulence. But understand the plane isn't crashing. It's just hitting turbulence before ascending to 40,000 feet. Now let's talk about the psychology, because markets are about people. Right now, retail investors are asleep. They still believe in stocks. They still believe in 401ks. They don't own gold. American investors are minimally invested in monetary metals. That's the contrarian signal, because by the time they wake up, it will be too late. In 1980, people were lining up outside coin shops to buy silver at $50. That was the top. You sell to them. But we're nowhere near that. Retail demand for silver is actually down this year, even though prices are up. That tells you we're still early. The frenzy hasn't started. What happens when it does? A mania? A buying panic. People will not take no for an answer. They'll pay any price. And that's when you, the prepared, are already sitting on your stack, smiling. Now let me emphasize something. Gold and silver are not investments. They are money. They are the measuring stick. Fiat is what's falling, not gold rising. You don't make money in gold. You preserve wealth as fiat dies. The dollar is in hospice care. It's still breathing, but the family is gathered around the bed. And one day the monitor flatlines. That's where we are. So where do we go from here? Over the next year, expect gold to break $4,000, silver to hit $60 to $70, miners to double. Over the next decade, expect silver at $200, gold at $15,000 to $20,000, because that's what it takes to cover the money supply. That's not speculation. That's math.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.